Welcome to The Explainer. Today, we're tearing into a semiconductor stock that has the market completely split right down the middle. Alpha and Omega Semiconductor, or AOSL for short. Now, if you follow the tech sector, you already know it's a total battleground of sky-high expectations and wild valuations. But AOSL, it represents a very different kind of battle. On one hand, we've got this compelling narrative of a deeply discounted tech stock with an exciting AI pipeline. On the other, a stark, flashing red warning about persistent unprofitability and sluggish growth. So today, we're going to break down both sides of this story using raw data straight from their recent financials to see what's actually going on under the hood.
Okay, let's dive into this. Here is our roadmap for today. First, the Q3 earnings snapshot. Second, the bear case, focusing on widening losses. Third, the bull case and that valuation discount. Fourth, their pipeline in advanced computing and AI. And finally, the ultimate risk-reward verdict.
Section 1. The Q3 earnings snapshot.
Let's start with the immediate catalyst that set the current stage, their Q3 2026 earnings report from May 5th. This report anchored the stock's recent price right around $34.69. Going into this, the market was really holding its breath, anticipating some serious struggles. But the headline number offered a pretty surprising twist. ASL posted an actual earnings per share, or EPS, of negative 28 cents. Now look, a loss is never ideal, right? But Wall Street's worst fears had modeled a loss of 41 cents per share. That means AOSL beat analyst expectations by an incredibly impressive 31.71%. Normally, a beat like that sparks a massive rally, mostly because it suggests the company is navigating a brutal environment way better than anyone thought.
However, the raw numbers tell a slightly more complicated story. For the quarter, revenue came in at $163.8 million. But despite that EPS beat we just talked about, the company still posted a net loss of $13.8 million. And this right here forces investors into a really tough spot. You have to weigh these weaker immediate margins against the company's long-term earnings potential. So, is the bleeding finally slowing down, or is this just a momentary blip in a larger downward trend?
That brings us to Section 2, the bear case, widening losses.
To answer that question about long-term trends, we really need to look at the critics' concerns. When you pull back from a single quarter's earnings beat and look at the company's sustained unprofitability, the bears definitely have some sharp teeth here. Just look at this number. Over the last 12 months, against $685 million in top-line revenue, AOSL posted a widening trailing net loss of $106.3 million. That translates to a trailing basic EPS loss of $3.55. For the skeptics out there, this indicates that the core business model is currently burning cash rather than generating sustainable value, regardless of one decent quarter.
And when we dig a little deeper, the bearish indicators really start to stack up. I mean, ASL's losses have increased at an annualized rate of 65% over the past 5 years. They've also had negative basic EPS for 4 straight quarters now. Compounding the whole issue is growth. ASL's expected revenue growth sits at about 7.4% per year. That noticeably lags the broader U.S. market forecast of 11.4%. So the bears argue that in a slow-growth environment, a company simply can't out-earn its mistakes. Those accumulated losses are just going to keep compounding.
Section 3. The bull case. Valuation discount.
But as with any complex stock narrative, there's a really powerful counter-argument. Has the market oversold the semiconductor stock? Has all this focus on recent losses created a massive discount opportunity for value investors? And this brilliantly illustrates exactly what the bulls are looking at. Check out this price-to-sales comparison. AOSL trades at a trailing multiple of just 1.6x. Compare that to their peer average of 3.8x and the broader U.S. semiconductor industry's massive 8.7x average. That is a striking visual contrast. Bulls argue that even with all those profitability concerns, a 1.6x multiple means the bad news is already heavily priced into the stock. They see a gigantic margin of safety here. But hey, a low valuation only matters if the company actually has the runway to survive. And that's where we look at the balance sheet, essentially the company's fundamental armor against those ongoing losses. Notice the breakdown of cash versus debt here. The company holds significantly more cash than debt, and we can actually see debt aggressively stepping down in their projections by the end of 2025. Let's quantify that resilience. They have an incredibly low debt-to-equity ratio of just 0.03, practically zero. On top of that, they boast a quick ratio of 1.79 and a current ratio of 3.32. What this means in plain English is rock-solid liquidity.
If they had to pay off all their short-term obligations tomorrow, they have more than enough liquid assets to do it. So, while the bears are absolutely right about the operational losses, the bulls counter that this balance sheet is a fortress, fully capable of absorbing hits while they engineer a turnaround.
Section 4. Advanced Computing and AI.
So, what does that turnaround actually look like? Well, it brings us to the most exciting forward catalyst discussed heavily on that Q3 call, their promising pipeline and advanced computing. The market for AI hardware is absolutely exploding right now, and AOSL is actively positioning itself as an emerging total solution provider in the space. It always helps to humanize dry financial data with some perspective from leadership. During the latest earnings call, CEO Stephen Chang expressed some real optimism about their approach. He noted, "This is going to be our path, the part of our reason of how we get to our billion-dollar milestone. They aren't just trying to cut costs here. They are aiming to sell higher value, higher performance solutions that naturally command much better margins."
And this ambition is formally mapped out in their midterm target model. The goals are very specific: reach that $1 billion mark in revenue. But more importantly, to fix those profitability issues the bears keep harping on, they are targeting gross margins greater than 30%, while keeping operating expenses right around 20%. If they can actually execute on this AI pipeline and hit these targets, well, that current 1.6x sales multiple might literally be the bargain of the decade.
Section 5. The final risk-reward verdict. This brings us to the climax of our analysis. We've explored the wild duality of ASL, a company balancing tremendous balance sheet resilience and AI promise against very real present-day profitability struggles. So the crucial point is how you personally weight these factors. Under strengths, you have that low 0.03 debt-to-equity ratio providing a massive safety net, a deep 1.6x PS discount offering value, and a real AI computing pipeline mapping a path to margin expansion. But under risks, you've got persistent unprofitability, a brutal trailing net loss of $106.3 million, and revenue growth that is currently trailing the broader market. It's a classic battle between a bulletproof balance sheet and a bleeding income statement. Which leaves us with the ultimate question to ponder as we wrap up this explainer. Looking at the immense safety of the balance sheet stacked up against the urgency of the operating losses, you really have to ask yourself, at 1.6x sales, is Alpha and Omega Semiconductor a hidden value perfectly positioned for an AI-driven turnaround, or is it a value trap just waiting to spring? The data is all laid out before you. I highly encourage you to dig into the financials yourself, listen to those earnings calls, and see exactly where you land. Thanks for joining me on this explainer, and keep learning.